This video is to explain the uncollectibles or the bad debt expense account in accounting. Have you ever lent money to someone and not been paid? This is what happens to companies. They make a sale on account and then later they find out that their customer is unable to pay. There are two ways to account for this as the company that made the sale on account. So the first method is the direct write-off method. In this method, it's a wait and see approach. They just wait and see which customer is not going to pay them, and then at that time that they determine they are not going to get paid, they debit bad debt expense and they credit the customer's particular accounts receivable. And that is how it is written off. This does not match the bad debt expense in the same period that they made the sale, so it's not in compliance with GAAP. But it is done by small companies or companies that don't have a lot of accounts receivable. Okay, the method that does comply with GAAP and does match is called the Allowance Method. In this method, at the end of the year, the company will make one adjustment for the estimate of all accounts that will be uncollectible. At that point in time, they don't know which customers aren't going to pay them, but experience tells them that a certain percent will not pay them. So in order to match the bad debt expense in the same period that they made the sales, they make an estimate. There are two different methods that they use to make the calculation. The first method is called the percentage of sales. The next way to estimate it is called the Analysis of Receivables. The accounts and the debits and credits are the same, but what changes is how to get to the amount. So at the end of the year, they're going to debit bad debt expense, and instead of crediting the accounts receivable, since they don't know which customers aren't going to pay yet because this is just an estimate, they are going to accredit allowance for doubtful accounts. This is an account that is like a bucket. They're going to fill it up at the end of the year, and as they find out who is not going to pay them, they use a little bit of that bucket up. They dump it out each time they determine a customer is not going to pay them. So it's kind of like a safety net. Oh, we're not going to get paid. Here's an estimate of how much we're not going to get paid. And each time we don't get paid, we'll take it out of that allowance account. So the percentage of sales method takes a percentage of sales, a percentage of credit sales times the percent, and that is the amount of the estimate. So you would debit bad debt expense and credit allowance for doubtful accounts for that number, the percent times the sales, credit sales. Now contrast that to the Analysis of Receivables method. Now you'll look at the Aging of Receivables report, and you will determine how much you believe is uncollectible. And then there's another step. You will look inside the allowance account, and you will make your allowance account be the number that you calculated. Okay, so let's look. At the end of the year, the allowance account has a debit balance of $100. Okay, this means that they have actually written off more than they had expected. That means that this is a negative $100 balance for allowance for doubtful accounts. Remember, this is a contra asset account, so it has a normal credit balance. But that's okay, because we are about to fill it back up. So the percent of sales method estimates that uncollectible expense for the year is $500. So for percent of sales method, we take that estimate and we put it in to our journal entry for the allowance. Just like that. So we go ahead and we debit bad debt expense for $500 and credit allowance for doubtful accounts for $500. And then if you wanted to look inside your allowance account, you would see that you only have $400 now. That's because we already had a debit balance of $100. If the company uses the analysis of the aging of accounts receivable method, they also estimate the uncollectible expense to be $500. Okay, let's see how we put this one in. Okay, we're using the analysis of receivable method. So our estimate is the number that we want this, our balance, to be for our allowance for doubtful accounts. So how can I get this number to 500? Since I already have a debit balance of 100, I would need a credit of 600, because a credit of 600 minus a debit of 100 would give me a credit balance of 500. So my journal entry must be for the 600 so I can get to the balance I want of 500. So the entry looks like this: bad debt expense, allowance for doubtful accounts for 600. So the last method is the direct write-off method. If we were doing the direct write-off method, we wouldn't have an entry because this is not an estimate. This is the wait and see approach. Okay, just to review, this method where we calculated our entry to be the 500, our estimate was the actual journal entry. This is called the percent of sales, and more specifically, this is called the allowance method, using the percent of sales as your estimation. This method where we calculated that we wanted our balance to be 500 in allowance is called the allowance method, specifically the analysis of receivables method. And then the last method is where we don't even make an estimate, is the wait and see approach, and it's called the direct write-off method. So the top two methods are they adhere to the matching principle, so they are in compliance with GAAP, generally accepted accounting principles. The direct write-off method does not match the bad debt expense with the sales in the same period, so it does not adhere to GAAP. Okay, let's look at this last part. During the year, the company received a notice that their customer Smith filed for bankruptcy. Therefore, his account of $50 is written off. Indicate which of the following is being used. Okay, so we're using some of our allowance in this first entry, and we're crediting the person's account. So since we're using an allowance for doubtful accounts, this is using the allowance method. Okay, so in this one, we're not using our estimated allowance account, so we don't have an allowance account. We basically waited and debited bad debt expense right when we were writing a particular customer's account off. So this would be using the direct write-off method. So this is how you would write off an account using the direct write-off method. There is no allowance account. And that is a summary of uncollectible expense for companies.